What's going on, everybody? So I'm not going to re-record this video one more time. This is it. Today we're going to be going over lesson 3 part B, part 2, whatever you want to call it, but it's the second half of lesson 3, and it's all about entry, stop loss, and targets. And so I'm going to go through live examples. If you didn't see part 1, then there might be some confusion, so make sure you go back and you watch it. But I'm going to take you through live examples. We'll start with ZAR versus JPY and a few trades that I've been following over the past few days. I haven't necessarily gotten in them because of timing or because of price action, but these are ZAR's really had some great structure, and that's why I want to go through it. If we have time, we'll go through another pair, but I think that that's going to eat up a good chunk of time. So let's begin. Let me shrink my face, because I recorded this whole thing and it was great. I don't actually know that it was great, but I recorded the whole thing and my face was the entire size of the screen. Also, don't pay $1,000 for somebody's course. You could take this course, understand that all you need to know is price action and market structure, and you're going to be a profitable trader as long as you manage your risk. So that being said, let's begin. Backing out here, and now we are on ZAR JPY. So you can see on my screen, I know that my face is in the way, but you can see that I've got all these on my watch list, all these different pairs on my watch list. I scan through them every day. I've got Coinbase pairs because I'll trade through Coinbase because I'm in the US. It's just easier. And then I got stock pairs, indexes, whatever. But I primarily trade Forex. So ZAR JPY has presented some great setups. I think it bottomed out here, on the 18th. But either way, going through what we discussed in the last lesson, or part 1 of lesson 3, the first thing I'm doing when I'm jumping on this chart, number 1, is I'm looking at the big picture. I'm on 4-hour here. I can zoom out. I could turn it into 24-hour if I want to, but you can see on 24-hour, the market has been in a downtrend. It has just come down over the past months, a year. And so we're coming off of a really strong daily downtrend that basically started on the 1st of January and bottomed out about around April, late April. And so what I'm looking for every time I'm trading is primarily the 4-hour structure. So what's the H4 structure? Here, I was waiting for market to shift or to continue structure. I actually shorted the downtrend thinking it was going to continue, but it ended up shifting. But either way, I need to identify the 4-hour structure. So as I go into this 4-hour, the first indication, and this can be reviewed, you can review this information in lesson 1, which is all about market structure. The first indication I had that the market was going to, at least in the short term, break its downtrend on the daily was as we did not make a lower low, and as we breached these highs. And so these were the first sets of highs that if we breached them, I knew there was some momentum to the upside. And then this was the real high that if we breached this high, we were clearly shifting structures, at least in the interim period. So what was the structure prior to that? It was exactly what we discussed in lesson 1. It was lower lows, lower highs, lower lows, lower highs, and then held the low. And that's your first indication that price is going to move up. We also started to get a heads up as we held the low, held the second low. Then we start to make higher lows. Now we're forming higher lows and we're pushing these highs. And eventually, once we breach that high, now you're thinking, okay, well, and this is kind of an ascending triangle structure, but that doesn't matter. Okay, I'm going to be looking for longs moving forwards, at least based on the 4-hour. And if market structure breaks on that lower time frame, then you'll continue to look for shorts and think that everything's going to continue back to daily. But at this point, we break the high. We're in bullish market structure. I'm looking for longs, and I did not really get interested in longs until we came down here. And so I was taking shorts as so this is the whole thing. Let's just start back here and let's look at longs. So as we breach these highs, these first sets of highs, we're going to look for pullbacks to support. So now this right here is support. This range here is support, and we're going to try and find a pullback into this range. But we don't get any pullbacks. The price never reclaims this range or retest this range. So price continues to move up. It actually blows pretty much right through this high. And you can see this would have been a support or resistance at the time. Resistance as well. This zone is resistance. And so you can see that the market, as it breached that historical high, it actually turned it back into support. And that is something we would have been looking for. That's where we would have been looking for a setup. So based on, we're back on April, the end of April. So we're just going to go forwards, and then we'll look back even further if we want more examples. So now we're looking for longs. We breached this high, and resistance turning into support. That's the whole play. It's breach resistance, flip it to support. And you want a large enough break that price has clearly reclaimed a resistance or reclaimed a level. So this is a great example. You can see here on this initial break, price does end up bouncing. So it's almost like we close above, we retest, and we bounce. But personally, for me, I'm not interested in that trade at this point. That's too tight. I need more time and space between price and the zone that I'm looking to trade. So time and space is generated when we swing all the way out here. We've had multiple days of closing above those highs or above these old resistance levels. And so now I'm comfortable at looking for price to turn from resistance to support. So just like we discussed in part 1 of lesson 3, now I'm on 4 hour. I've been on 4 hour this time, and I'm looking for entries. So as I see, this is an H4 structure. So this is a 4 hour structure, preferably entering on H4 structures over H1 structures, but H1 structures are totally valid. In addition to it being an H4 structure, or demand, what I would now call a supply flipping into a demand zone. Now we would look for it to turn into demand where buyers are present. In addition to it being H4, it's also a daily support or old resistance. So it's got some confluence in the fact that it's H4, so that historical market structure is lining up with this daily level. I've got additional support. I've got additional reasons I could take this long and think that my stop loss would be protected. So we're going to look for entries by going down into this 1 hour. And you don't have to do it this way. A 4 hour close, 4 hour trigger candle is going to be much stronger of indication that your level holds. But as you get experienced, you can look for these 1 hours. And if it can save you even a few pips on your entry, you're going to notice a significant difference in your risk reward ratios in your favor. The longer you wait, or the more confirmation you wait for on a trade, the higher your probability is of success. But at the same time, the lower your risk reward ratio is going to be the more you wait for that confirmation. So the earlier you get in, the more profits you potentially have, but the lower probability of success. So I'm zoomed in. We can see that we broke above. We had that time and space we were discussing. We came back to retest, and we get this beautiful long lower wick that dives into our point of interest, into our zone of interest. So if that candle does not trigger you in, which I would be right on the edge of my seat at this point. I don't think I would be in the trade. I would wait for this push away. So you can see this candle right here. This candle right here. I'm doing a great job of marking it. This is our push away candle. We actually break away from that level. And so I am now placing an order. I've entered. There's some sort of slippage. So when you're placing your stop losses, when you're placing your entries, when you're placing your targets, you always have to account for the spread. The spread, it varies per pair. For this pair ZAR-JPY, maybe it's like 2 pips right now, generally ranging around 2 pips. And that spread is something you have to take into account. So what I mean by the spread is if you place your stop loss here, and I've got my stop loss right below this wick, if price comes and it comes to this point, approximately, I'm making up this point, it's going to stop me out. And it never hit my stop loss, my actual number on my stop loss, because what happened was the broker triggered my stop limit order early because they have to take the spread, because there's a spread in there, and every entry order you place, every stop order that gets triggered, every profit taking that gets triggered. Your profit taking is going to get triggered earlier than the placement of which you put it. It's going to get triggered by whatever 2 pips early based on the spread. Your stop losses are going to get triggered 2 pips early based on the spread. So you have to take that into account when you're placing your stop losses and your target profits. So right here, I've got an entry order and I've triggered in, and I'm going to have my stops below this range. So now comes the discretion, where you're going to have to decide, what is the proper or optimal stop loss placement. As we discussed in the last, or part 1 of lesson 3, the structure is key to placing stop loss. You want to be placing stop losses when taking longs below recent market structure lows. When you're taking shorts, you want to be placing stop losses above recent market structure highs. So in this scenario, the best places for me to place stop losses would be either here. I could place it below this dip, or I could place it below this dip. I would not go any lower than these 3 points. And what do you think your safest stop loss placement would be? And it clearly would be below this low. The more levels of historical support that have come into play, these clearly were support at certain periods in time. And the more levels I have between my entry and my stop loss, then the more defense I have, the less probability of it stopping out. Now, if the market dumps, it's going to blow through all these levels. But you ought, at the same time, you have to come up with what is a reasonable risk-reward setup, because if the probabilities or if the ratio is not in your favor, then you're going to have to be right. You're going to have a very high win rate. If you have higher risk-reward returns, meaning, I'm risking 1%, but every trade I take, I'm at least winning 2%, then if you have those higher risk-reward returns, you don't have to win as many of your trades. You don't have to be right as much. And it's nice when you don't have to be right as much, because then there's not a lot of pressure. But you have 3 places you can put your stops, and what you're going to immediately do to make the decision on, where am I going to place my stops, is first, you're going to gauge the strength of the market. Do you think that this is a bullish market? And, I think it is. It's shifting, but at the same time, this is not a very long trend. It's not a trend that has been intact like back here, where this thing was running in a downtrend for months on end. Now we're in a very fresh uptrend. So you got to take into account that there's not a ton of historical trend behind your long right now. There is market structure, and market structure is clearly bullish right now, but that's just something to take into account. Price could dip further if it's a softer or trend that has less conviction. So as I begin to place my stop loss, I'm going to first look at the strength of the trend, and then I'm going to see where are my initial targets. As we discussed in the last lesson, or maybe it was 2 lessons ago, your safest way to take profit is going to be by, when price reaches a 1-to-1 risk-reward ratio, you close half your position, you move your stop loss to break even. Now you've gotten profit, and you can ride the remainder of the trend for free without any psychological disruption or psychological challenges, because you're now break even. You now have no skin in the game. So house money, great. I love playing with house money. So you got to look, where are my initial targets? And your initial targets on a bounce like this in trend are always going to be that high, that recent high that has occurred. So the recent high that occurred was up here. We moved up, we formed a high, we pulled back. So now we're going to look for a retest of that high. And it's not that price is going to get there, but that's what we're going to be looking for. So as we look sideways, I see that reasonably, I can place my stop below this swing low, and I can get a 1-to-1 risk reward if we get back to the highs. If you place, so think about that. Now what you're saying is, in order for me to at least come out with a 50% taking my profit, moving my stops to break even, in order for me to at least come out with that, a 1-to-1, then price has to get all the way to the highs. As you tighten your stop loss below these local lows, Now what has to happen? Price does not have to get to the highs before you hit that 1-to-1. It's going to happen faster. So you can see here, look at the stress that we took away from ourselves. It's really cool. So we get the bounce, we get the entry. If I had placed stop losses below this low, then the stress gets removed right on this tip, right? I've taken my profit, price moves back. I don't have to worry about it pulling back so violently. If you were down here with your stop loss and you were waiting for price to come all the way back to this high, then what happens is, you're like, oh, great, I'm in profit. I'm in profit. Bam, it just slams on top of you. Price goes right back into a loss. After you were almost 60% of the way to your take profit, and you've now been hammered. So this sector right here, this zone, is going to be a psychological challenge for you. I had it happen today on Australian dollar versus Canadian dollar. I'm in great profit. I'm in 1.3R. I've fortunately taken at least a third. I didn't take half. I took a third of my profit, moved stops to break even, and I got high impact news, and it just crashed the market, crashed my long. All my profit wiped out except what I had already taken off the table. I end up closing it, and I make about 0.37% on the trade that was looking so good, looking like I would have made 2 to 3% on, and it's not how it turned out. So you're going to have to deal with these psychological scenarios where you're in profit, and then the market slams against you. So you had multiple points where you could place your stop loss. I reasonably would have had it. I'm fairly conservative. I would have had it below the zone. I would have been waiting for this high, got to the high, cut part of my position in case we get rejected, and then price is moving up. And you can see you've got just a great runner that even if you had taken that longer stop loss, look at this, to the highs, you'll never catch it right to the highs. I'm telling you that. You'll never catch it to the highs. But to the highs, 4.29%. Or risk reward, 1 to 4.29 risk reward ratio. If you had that stop tighter above those local swing lows, then you're looking at almost a 6%, 1 to 6. So that's the difference. Those little shifts in your stop loss placement, those are going to make a huge difference in your risk reward. You can't change your entries. The entry trigger is the entry trigger. You don't get a decision on that. It needs to be a clear entry trigger. You're waiting for a very specific move from the market. What you do get a decision on is under which low or above which high you place your stops. And that is going to have a huge impact on what your risk to reward ratios are. So there was trade one. It was successful. We're now going to continue up. I'm going to remove these stop losses that I placed here, or stop potential market structure levels that I placed there. So we're on the 4 hour. We're going back to the 4 hour, and we're going to continue to look for structure that we can trade. And you'll see, I just already know this because I've been following this pair, but there's not, I never get a retest of this level until all the way down here. And there is a problem with playing a trade like this. So we'll go over that in a second. So this is a clear support or a clear resistance, which you'd be looking to turn into support. But let's see if we can get any more trades here. I've got a structure here. I can take this trade right here, wherever retest. I'd like to get some closes, so this rounded retest would be good. All right. So we will zoom in. We've got these marked out now. So the market runs in, we run into resistance. For me, this is too tight. I'm not going to be taking this rounded retest or this tight retest of this level for long. I would want to see it, like I said, time and space between the point of which I'm trying to enter and in recent price history. So I need time and space. So we get this rounded out action. There is something really key to know here, and I've got it drawn out. I knew that there was a trend line resistance, a major trend line resistance. This is why you prepare your charts. You don't want to overclutter your charts, but you do want to prepare with very basic high time frame, clear trend lines, not ones that can be left to Is it here? Is it at this angle? It needs to be very clear. I go by the tips when I'm drawing trend lines. But either way, that's a separate conversation. So we round out, we come back, we retest, and on this long rejection of this level, the price has clearly tested this level. I will be placing an entry. I'm looking for a long, ignoring this trend line in the example. And on a wick that is this long, so this is another good piece of information. When a wick is this long, it is there is no reason to have your stop loss all the way down below some local market structure, some local low down here. A wick like that, you do not want to see price come back to the lows of that wick. If price comes back to the lows of that wick, the game's over. As soon as it starts actually closing deep into that wick. So like, let's say price is, we'll go to the, now I'm going to 15 minutes. So keep in mind that I'm flipping time frames. So that was the wick. So if price had started closing all the way down here after this long wick was generated, I would not allow the market to come back and fully stop me out, take me out for an entire loss. I would most definitely be closing the position, because with some sort of rejection that significant, you want to see the market immediately begin to push away from your entry. So we've got this entry here. You can see we get at least a 1-to-1 risk reward. It actually pushes up to about a 1.11, but we would have been taking profits at a 1-to-1 and then moving stops to break even. So, it hits profit taking point, moves stops to break even, comes and stops us out. So now we're stopped out of that trade, but we're stopped out with half of our position we profited from. This is a pattern that I'll talk about in later videos, a swing failure pattern, but a clear indication market took liquidity and then slams down. This is a typical move in the market. So as we break that level, I've lost interest. I've really lost interest until we come up and breach these highs. Until we can make a new high, I don't have any interest in trading longs. The market's starting to look weak. Especially with this long wick, you are not interested when you see a wick that takes the highs like that. A wick that takes the highs generally means, or takes the lows, means that it's going to make a reversal. And I got to discuss it later. But either way, the market breaks down. I'll go back to the 4-hour because that's going to be our primary time frame for analysis. The market breaks down. And in my eyes, after I saw this 1, 2, 3, so we got our first breakdown, we got our lower high, and then we got a lower low. And so you can see my little arrows here. I traded this short, and I did come out, scrape out some profit. It was on a Friday afternoon. You can see it turns from like the 19th to the 21st. So yeah, it was weekend. But this is another level where I think I got to back up, rewind. Why, if I have this great support that was established over here on May 26th through June 1st, like almost a week of establishing support, why would I not be trading this long? And the reason you want to trade this long is because of how violent of correction this is. This is not a simple sell-off where we get kind of a stair-stepping move down and it comes down and it curls into that level. This is a violent distribution. It shoots down so swiftly that there's always potentially more momentum coming when you see something that violent. That's why I exited my Australian dollar, Canadian dollar pair today. It just slammed down so violently, I needed to close the rest of the position. So there could have been momentum left. And as we've got this bearish market structure forming, I'm not going to take a long, but as we breach these lows, I'm most definitely looking for a short. Oh, it's just killing me. Oh my gosh, we have our targets. What does that mean? So this was a great setup. Market breaches these frequently tested lows, and then it comes up to retest it. And so I was looking for a short. It's very simple play. Break, tested once, tested twice, tested 3 times. Maybe you could even say 4, but just 1, 2, 3, and we come up to retest. And so now what are you doing? We got a 1 hour, and it's really a 4 hour or a H4 structure or a support resistance. And so now we've got support flip to resistance. We're going to go in to these lower time frames to try and find an entry. So as you get better, you're going to be able to say, oh gosh, we're coming up to this key level. I want to take a short. And instead of looking for a 4 hour close, instead of looking for a 1 hour close, you're going to be looking at perhaps the 30-minute or the 15-minute to see if the market's showing rejection or showing that your level is going to hold. So as soon as we got to this level, I looked at the 15-minute chart and I'm zoomed in and I'm looking for rejection. So see this red arrow, you can see the program for Owanda actually shows. As soon as I saw this rejection candle, I was in. I was in like Flynn. That was a perfect rejection. I don't need any more information, just personally. And so we closed down here. There are some caveats to this. There was a high spread at the time. The spread in the order book was really high. So I had stops all the way up here, and I figured that there was some significant targets that went way lower. But I knew I at least had a 1-to-1 going to my lows. And that's typically what you're going to want. At least to those local lows you're targeting, or when we're long to the like local highs, you're wanting a 1-to-1 between your entry and your first take profit. So you're at least wanting that 1-to-1 to get generated off of the local low or the local high. So in this case, to the local low was a 1.12. I would have been taking profit, a 1-to-1 right here. And you can see the market did not reach it, but this is actually a separate day. The market closed. So either way, I had stops all the way up here because there was a spread and I didn't want to get caught with a high wick because of the spread in the order book. So I got the rejection candle. It triggered the entry, placed my stops above the zone. If price had started to close up here, close above this zone, if price had started to close above that zone, I would have closed the trade. So in my mind, if you have these wider stops, you're going to have lower risk to reward. But generally, when you lose the trade, if you're going to lose the trade, you're going to be given an opportunity to close it early based on price action closing against you. So if price had really closed above this level, even down here closing above the level, I would have closed my trade. I might have come out, instead of losing an entire 1%, I might have lost, I don't know, the 1.12 and then 0.8. I might have lost like a 0.66% of my capital on that trade. Maybe less. It just depends. So there's a great setup. Perfect rejection candle. Use the 15-minute to trigger my entry. And now we're going to go back to the 4-hour time frame. So on the 4-hour time frame, we see once again, let's cover again that we are in a 4-hour uptrend, even though this is broken down, until we really breach these lows right here, these local lows, and make a new lower high. Then I'm under the assumption that when market structure shifts, when it shifts back to bullish, which it does here, then I'm going to be looking for longs to continue this 4-hour trend. So unless we had come all the way down and breached below these lows, and we had come all the way down and then we had just formed a lower high, I would have been continually bullish on the market, at least from an H4 time frame. And so that's what I was. I was looking for this for an entire week for this trade. Once we cleared this this high, market structure started to shift. This high right here. So we got a shift in market structure. Here's a higher low. Here's a higher high. Here's a higher low. Here's a higher high. Now I was looking for a pullback to this clear demand zone, this clear support. And it happened at 1 a.m. So I got this nice lower wick down here at 1 in the morning. So I was not trading at that time. So I did miss the trade because it quickly pushed away. But this would have been a great setup. Let's look at what you would have done to enter this setup. If I go to the 1-hour time frame, I can see price pulls back into support. I get that long lower wick. it actually, I don't have green or red candles, but the candle closes green. It's also referred to as the swing failure pattern. I already said I would discuss it later, but this is a great pattern. When you see this, you generally get a nice push in the opposite direction. So got a nice swing failure pattern, long lower wick. Place my stops below these lows, below this support, and I look to first target the highs, just like always. Then we're going to take off, risk it 1-to-1. That's up to you. You can also let it ride longer, but it's at your discretion. It's a risk management move, because the trade sure as heck could have come here, gotten a great rally, and then come right back against me. That is always something that could happen. You're not going to win 100% of your trades. You have to manage your risk. So we get a great long here. We target highs, and then we just let the remainder ride. And we're taking profits. We're averaging or slowly scaling out of our positions. I think a real good profit taking point would be this trend line or this daily level. So that was a good setup. And then once again, yesterday we had a setup that I did not take. I was actually recording this video and it failed. And, I left my face big on the screen and I recorded a 37-minute video. Great. But I said I was not going to take this trade during the video because look at that price action versus this price action. These look very different. So at first, when we got this nasty rejection candle, I wasn't interested until we reclaimed the level. I want that level reclaimed, and then it's still valid. So it's a closes above, retest, bounce, and run. But we got all of this nasty, just not knowing what's going on, candlestick action. And you can see these are very clear differences. If you look anywhere else in here, you don't see price action that choppy. So I just said, hey, there's other trades today. I'm in 2 other trades right now. I'm not going to take that. And it did become a profitable trade. So, ideally, if you were the guy that was going to take this trade, I wasn't, obviously, because I didn't make any money off it. Then you would have had your stops right below these lows. You would have had it here. You would have been targeting 1-to-1, and you'd be in profit right now. So right now we've got a potential support resistance flip, but we are getting very close to this trend line resistance. So this would be another setup that is actually a lower time frame setup. This is more so a 1 hour, in my opinion, an H1 setup. And so we're coming into this support, and now you're looking for price to kind of move away. And you can see that initially it came down and it popped up and it sold back down. So if you wanted to enter, you could enter here, but just know you have to know this, the lower time frame that you're trading on. So in this example, this is more of an H1 entry on the 15-minute for me setup. This is going to be a lower probability of success than this trade down here, which was based on the H4. Definitely a lower probability. Far lower probability than this, which was based on the H4. So you don't have to risk the same percentage every time. Perhaps you would have said, I'm going to risk 1% on this trade. I'm going to risk 1% on this trade because they're H4. And now I'm on H1 and I'm only going to risk 0.5%, and I'm going to try and get this move up to daily. So you have options. You don't have to always have a fixed percentage risk on each trade, but you do not want your percentage risk to start exceeding 2%. I don't suggest that at all. I mean, people say that, you got $1,000 account or, $10,000 account, then you need to be risking 2 to 5% at least, because you got to make some money. And that's just stupid. Aren't you supposed to treat each account like it is the $100,000, $200,000, $300,000 account? And in my eyes, you should treat every account size you have like it's you trading that $1 million account. Because why are NBA players going to only start doing the right thing when they get to the NBA? No, they're going to be doing the right thing the entire time, and that's how they get there. And if you need more money to fund your Forex account with, then you need to get another job. Continue to save over the next year. This is not an overnight process anyway. You should be practicing day in and day out. This isn't about you being the guy who just pumps your account with money and then loses it all in the first 90 days like most people do. I mean, build up a small account first, and you're going to feel a lot of pride, and there's going to be the stability, the psychological stability, being able to risk more and more capital gradually as you're building it versus just this massive Today I'm risking 50 bucks per trade. Tomorrow I'm risking 1,000. You're going to be totally smashed psychologically between those two differences. I mean, experience a 5% drawdown when you're risking 1,000, you're down 5 grand, and then 5% drawdown when you're risking 50, you're down 250 bucks. It's very different scenarios. So that is the example video of how to enter these trades, where to place your stop loss below potential structures, how to find the balance between the stop loss placement and the risk reward ratio. And there's so many more nuances about how to read the price action that I really need to go over. But that's just going to have to come in future videos, because this video would be endlessly long and I'd have to ramble to get to the conclusions, because you just start trading. Once you really have done it a while, you just start, these things just kind of start coming naturally, like, oh, I didn't want to see that price action, so I'm not going to take it. Oh, that's kind of rounded, so that could be forming a solid bottom. There's so many nuances that start to come naturally and you don't really think about it. So I will try and put together some videos with the nuances of entries, nuances of price action videos, and hopefully those can help. But if you have any questions, please leave them in the YouTube comments. If you like this video, give it a like. If you want to see the full course, you can go into Confluent Trading YouTube channel. It's totally free. There are no hooks. If you want to follow all of my setups, you can follow them on Telegram. I post everything, including the outcomes, including when I cut the trades, when I scale down, when I move stops to break even. So if you want to follow my Telegram, I'll put that in the description. So y'all have a great day. Good luck at improving at your skill of trading. It is a beautiful thing once it comes to fruition. So have a nice rest of your day.